All right. So again, welcome to the webinar. We are going to get started. I'm going to go ahead and introduce everyone in just a second. We are also live on Facebook. So for those of us watching us on Facebook and streaming, welcome there. We're going to have a team monitoring the comments over there. If there's questions that come through, we'll be helping to answer that as well. Now, I got to correct myself. Sometimes I'm going to say it's Compass Capital, but of course for us, we've had a name change on our side. So I can't say it's Alfred and Nate from Compass anymore. We're officially Diversify Capital. Super excited about that. Of course, we have Nathan from our team and our co-founder. How are you doing, Nate? How are things on your side? How excited are you about our name change?
Stoked about the name change. That's really exciting news, something that represents our values much more. So very excited about that. Yeah, it's been a good change.
Yeah, absolutely. We'll share that with you guys, of course, on our website. There's a little bit about why we're doing it, and if you're interested in learning more, we can give you guys a link for that. But of course, we got two of our other wonderful panelists that love joining us on these webinars. We have Nikki, our mortgage advisor. How are you doing, Nikki?
I'm great, thank you.
Yeah. And Nikki today is going to be talking a little bit about just some of the changes in the mortgage side, some rates. So we're really excited to hear from there. And Alan, our real estate specialist. Alan, how are you doing on your side?
Great. It's nice to be here.
Yeah, thank you for joining us. There's so many things going on. I can't tell you on a day-to-day basis how many questions we're getting about now the right time to buy, right? I mean, every single day. And so you guys might be saying, hey, Diversify, you guys have been doing a lot of webinars about real estate. Well, it's because we're getting a lot of questions about real estate, and Alan can tell you how busy he is because of it. And we're going to be talking about with Alan, again, how the markets are, what he's seeing in the uptick of transactions. So that's going to be good to review. But as always, I'm going to start with some disclosures, right? I think it's important. We're doing a webinar that's opened up to a general audience. So we want to make sure that when you guys are listening into the webinar, we're talking about certain topics. And today, of course, being real estate, we're talking it from a general education perspective. Yes, we do provide specific financial advice, but that's for our clients in an individual setting. And so on a webinar side, please use this as general education and not specific financial planning. Nikki, I know that you have your MLS number that you want to put out there as well. I think we should do that because we're going to be talking about some rates.
I love doing this. My NMLS number is 293138. Yes, I have to say that. Thank you for asking.
Absolutely. Alan, is there one on your side that you have to state as well?
I don't have to, but I guess I will. 01793936.
Awesome. We've got that out of the way. So at least for right now, some other disclosures, we're not going to be talking very much about investments or taxes today, but anytime that we do, again, it's from an education perspective. We're not trying to solicitate you to buy any investment products, nor treating anything that we talk about as your tax preparer, right? Those are questions that you should be directing to them in particular. All right, so we're going to get started. And again, the core topic of today's webinar is to discuss, is now still the right time to buy, right? We've talked about a couple of times in our webinars, the different fluctuations about how the pandemic has changed the real estate market, but where are we today, okay? So let's first dive into where might some of the money be coming from to be buying houses, right? So that's the financial markets. Nate, give us a little bit of background about what you're seeing right now in the financial markets and how things have changed maybe from March 23rd when we were seeing the bottom, right? What are you feeling right now? What are you seeing and telling our clients?
Yeah, I think we had a lot of potentially panicked people with money invested, hoping to use that for their down payment in February and March. Had they stayed invested by this point, as everyone knows, markets right back at all-time highs, mostly fueled from fiscal stimulus though, right? So I always reference 2008, we did $985 billion of stimulus. Fast forward to 2020, Federal Reserve slashed rates to zero, expanded their balance sheet $6 trillion. The HEALS Act was another $2 to $3 trillion, or the CARES Act, sorry. And now the HEALS Act that they're working on could be another $1 to $3 trillion. So we're talking 10 times the amount of stimulus that has hit the market. So from a Wall Street perspective, it's not a surprise that the stocks are right back at all-time highs. From a actual boots on the ground, individual financial impact, it takes time for the real economy to feel that benefit. So a lot of people may be thinking there's a huge disconnect between Wall Street and reality. Makes sense. It's just, again, takes time for that to trickle down. We have seen some economic data to support a V-shaped recovery, but obviously with the second wave hitting, that's putting a little bit of a lid on some of that recovery that we're seeing. And really what's worked in the stock market this year has been tech companies. The NASDAQ is up 20-something% this year, which truly benefits a lot of our Bay Area clients here because of all the technology clients that we have. But that said, a lot of our technology clients are not immune to this. A lot of them are having to forego any sort of raises or promotions this year. A lot of tech companies are also saying zero bonus allocations for this year. So their personal finances are impacted by this. But more importantly, a lot of that down payment money that might have been invested should be fully recovered and back into positive territory for 2020. Now, looking ahead, we have the election in less than 3 months. I think it's about 2.5 months away. So we do expect some volatility in the markets to pick up as we get closer and closer to that election day. So as tempting as it might be to keep your money invested, especially when you see all-time highs in the market, you see stocks like Tesla hitting 2,000. If you're planning on buying in the next 6 months or 12 months or less, I think that it might be a worthwhile time to take some of that money off the sidelines to prepare your down payment so that you're not worried about another February or March event happening to your down payment. I don't know if that's going to happen. Nobody does. But again, if you only have so much time to invest and knowing that the market's right back at all-time highs, a better time to prepare that down payment and put it in cash if you're looking at buying in the short term. So that's kind of what we're seeing in the market and kind of some of the thought process for where to put your down payment if you're thinking about buying soon.
Yeah, thanks for that, Nate. And I think a client had asked me, what should I be expecting in a money market or cash fund right now? And I think just how quickly interest rates change, which Nikki will talk about, just from an investment perspective. A lot of the Marcus Goldman Sachs savings accounts, the Capital Ones, which was pushing close to 2% at one point, right? Now it's closer to down to 0.8%. And that's still actually a pretty good rate. You have things like the Wealthfront Cash, other of the robo-advisor cash accounts, which were above 1%, are now down to like 0.2, 0.3%. So certainly a compression in what is considered a risk-free asset. If you're getting close to 0.8 to 1%, that's actually still a pretty good rate. To Nate's point, parking it there in the meantime might make sense to reduce some of that volatility. Right? And so that's, of course, the investment market side. Alan, what are you seeing on the real estate market side? What are you seeing on your end about how the markets are going, how the real estate transactions are going?
Well, right now we have high demand and low inventory. I'm done. No.
Okay, straight to the point. I like it, right?
How do I share my screen?
So at the bottom, you should be able to see share screen.
Can you see it?
Not yet, Alan.
Okay, share screen, share. And
Coming up. Yep, see it.
there we go. So really what's going on right now, like I said, we have high demand and we've got low inventory. And that's really and interest rates are really what's driving this market right now. And what we have is, what we're seeing is, if we go back to San Mateo County's, this is just San Mateo County market trend. If we go back and we look at last year, this is just new contracts that were taken in for the last 4 weeks, and this is just for July. There were 585 brand new contracts. That meant what went into contract from active and depending. This year, for 2020, there were 734 new contracts. Now, the interesting thing is, if we go into August, right now, what's pending is, what's active, there are 839 active homes. Out of that, 595 of those are single family homes. And if we just take Peninsula homes, there are 190 available homes on the market right now. There's just not enough inventory for the amount of people that are actually looking. So it's an interesting stat when you're looking at something like this. 734 new homes that are pending just in 1 month. So it's keeping Nikki really busy. Not to mention the people that are going into getting pre-approved. And so we are just seeing these low interest rates, people just moving into getting pre-approved and wanting to buy. We thought this pandemic was going to halt people, and you'll see by another graph that I'm going to get to in just a moment. Right now, oops, now let me move this. How can I move this? Because it's, there we go. Right now, this is the active listings on the market. What I love about this is it actually it shows that in the month of July, the number of active listings are dependent on two major factors: how many listings sellers are putting on the market and how quickly buyers are snatching them up. And you can see in October of 2018 how quickly they snatched them up, September 2019, and then July 2020, where this is where I think the media just went completely off the rails. They set us up for failure in March and April, and then May and July went completely left turn at Albuquerque, because everybody was set that we were not going to be doing any business. And what ended up happening was May and July, look what happened. The sales just went through the roof, where real estate agents, top producing real estate agents, were just busy. We just had no time, because look what happened. And you know, this measures how many active listings went on and what transpired. Okay, it doesn't take into account it doesn't take into account the contingency periods of oh wait, wrong slide. We're going to get to the next one. Sorry, I was going off my notes. This one takes into account the number of days on the market. And now what I love about this one is this shows the average days on the market on the for San Mateo County specifically. Now, for our area of the peninsula, the average days on the market, if you go and you look at July, it shows the average days on the market are roughly around 28 days. Now, this is skewed a little bit, because agents such as myself, we don't put a property pending until contingencies have been removed. So if an offer has been written and it's got a loan contingency, or it has or money's been put into escrow, that's another one. That could be 3 to 5 days, and in some cases a contingency could be 8 days. So where this shows 28 days, we move this down. This is actually more likely 18 days on the market. Okay, so the average sale for a property to be sold is not 28 days in our area. It's more than likely 15 roughly. So taking this into account, the contingency period, so it's actually less. Where we're at right now in July, August is getting worse. So the days on the market are not getting longer, they're actually getting shorter. Now, this is for single family homes. Condos are different. Condos, for a first-time home buyer, for a buyer right now, I say this, I use this, kind of take this with a grain of salt, because single family homes, buyers right now are really paving their way of what they want for a lifestyle, because of shelter in place. Mm-hmm. Buyers right now want a yard, they want land, they typically want 3 bedrooms, because if they don't have children, or if they have one child, they want another room for an office. They want to be able to they want to be able to walk to the outside if they get stuck in their house for the next 30 days, not to be able to walk outside. So if they're in a condo, you can't do that. So condos right now are taking a little bit longer, because buyers right now are being a little bit weary on that. They're being very cautious before they just jump into a condo. And so we're seeing the condos in the city sit a little bit longer. And the media is not helping with that. The media is saying, was published this week that condos are getting hit hard. I don't think that they're getting hit hard where we're going to see like in 2008, 2009, 2010, where we saw a 30-40% decline. But I think what's happening is they're not flatlining, but we are seeing them sit a little bit longer where it's not going to be 15 days on the market. Then those are going to probably be the 25 days, the 30 days, because what's going to happen is you're going to see a little bit more, maybe instead of 2 or 3 condos, you're going to see 5 or 6, and you're going to have a little bit more to choose from. And so rather than jumping into one, that's what's going to happen. And a seller is not just going to let their condo go. They are going to hold strong because they're going to hold strong to that dollar amount.
Yeah. And we're seeing that too, Alan. I mean, anecdotally, I think we're seeing a lot of our clients, if they're renting in the city right now and they're considering to buy, guess where they're buying? That's buying outside of the city, right? They're searching for that space that you're talking about. And I think that's very relevant to a lot of people. And it does show to your point, maybe the media is a little drastic, but at the same time, right? Anecdotally, you'll see people saying, hey, I had a condo in SF, my rent was this, and the tenant moved out. And as I'm posting, I'm not getting similar rents. And that's where they're still considering now selling. And so it'll depend on what price point and all of that. But that's certainly true that the single family homes that you're seeing, I can certainly see why the days on the market is not very high at the moment, because people are still picking those up because that's where people are going. They're coming out of the city to find the space.
Well, in the rental market, talking about the rental market, it's gotten hit a little bit harder as well because people are wanting to buy. And we also have the rent control over the whole state of California now. So the homeowners are a little reluctant to rent now at a lower rate because they can't increase their rent like they could have, a year ago. So there's this catch-22. What is it? The dog chasing the tail. So they're a little reluctant to do that.
Yeah.
This slide is the San Mateo County house sales. And so this shows the median sale of a property. And so right now, the median home prices are, when we look at this, we've got, the median home prices are roughly around $900 a square foot if we look at this overall. And this is showing for a 1,560 square foot home in the center at 1.4. Overall, what I am seeing is about $900 a square foot on the peninsula. And I'm just because this takes all of San Mateo County and combines it all together. What I'm seeing is on the peninsula is roughly, and I'm taking from Daly City all the way down to Redwood City, we're looking around $900 a square foot, depending on the peninsula and depending on the area. And this is where the numbers get shocking. So again, depending on the area, it's roughly around $1,200 to $1,400 a square foot on the peninsula. San Mateo, the city of San Mateo is roughly around $1,000 a square foot, where San Carlos, depending on the area of San Carlos, you're looking at $1,100 to $1,400 a square foot. And Burlingame is $1,200 to $1,400 a square foot. Now, if it's new construction, it goes up. You're looking at $1,500 to $1,600 a square foot. So that blows it all out of the water at that point. Yeah. So numbers, again, this takes all of San Mateo County. That takes, La Honda, Half Moon Bay, Pacifica, and throws it all in there. So you kind of take these numbers with a grain of salt. And that's why I thought it would be better to point out some more statistics, stat numbers that would be more heavily defined.
Yeah. And so from what you're saying and from what we're interpreting is that the numbers are still up there. The numbers are still high. You have, right, the demand being high without inventory. So, and this is a question that I had a client ask as well, like in 3 months, in 6 months, right? Do you anticipate, are you seeing anything that's telling you that the inventory would pick up?
So I'm going to get to that. So inventory wise picking up, we actually have not slowed down in inventory. So the inventory is still, when we look at overall, we have never the inventory of 800 homes on the market in San Mateo County, it has always been roughly around 800 to 900 homes on the market. And when you look at, if you go to last year at this time, what it is it's days on the market that we're having the problems with. It was, if you go, a few years back, the days on the market were 45 days, were 60 days. Now it's the shorter days on the market that we're seeing. And so, like, using San Carlos as an example, only because I just helped a client purchase in San Carlos, where it's consistently 20 to 25, 20 to 30 homes. Well, it's roughly 20 to 28 homes consistently on the market. And there's anywhere from 7 to 10 homes every week on the market. And they're selling like that. I mean, it's constantly. And when a home comes on the market, it's 7 days pending, 7 days pending, 7 days pending. But the new homes are coming right behind it on the market.
Got it. So, and I know you will talk a little bit more about this in the market forecast at the end, but it seems like, to that question, maybe it's more of a perception that inventory is low. It's getting snatched up quicker at the moment.
That's the problem. It's getting snatched up faster.
Got it.
That's the problem. And that's why the perception is there's not enough inventory on the market. It's actually getting snatched up faster, and the days in the market are getting shorter and shorter and shorter.
Got it. Thank you for that, Alan.
You're welcome. The luxury home market. So our sales volumes are increasing, are definitely increasing, not decreasing. And so our medium over the last 20, and this is over the last 24 months. And so even this, as they put this out, I can appreciate this, but at the same time, it shows, we'll use Burlingame as an example, or use San Carlos. It shows, the medium price over a 3,025 square foot home is 3.3. Actually, that actually is up, and it's 1,054 square foot. It's actually $1,300 a square foot, because the housing pricing has gone up over the last 6 months. It's jumped that much. I just helped a client get into a 2,600 square foot home. They paid $1,300 a square foot. I mean, it's that crazy. And Burlingame has increased to $1,200 plus a square foot. So as nice as this is, it goes back 24 months where the pricing was less, but over the last 6 months, the pricing has gone up. So this is skewed off a little bit so when I show this graph to people, as I was going over this last night with my husband, he said, well, wait a minute, we can get a house for this price. I went, no, you really can't anymore for this price for $1,187 a square foot. You can't get a 3,000 square foot home for that price. And not even on the other side of the freeway, the other side of El Camino. They just don't exist when you've got multiple offers bidding it up for that price, unfortunately. Let's see. This is when you were talking about, overall the trends. So the medium sale price, this graph I love the most, because this is the San Mateo County home pricing appreciation. So we have some clients, you and I, and that have purchased homes over the last few years and are going to be selling. And so in July 17, you can see the dip, and then you see the increase all the way over until January 19th, this big increase. And then you see a slight dip, and then you see an increase into January 19th. And then if you look, you can see July 20, there's a huge increase again. And so as we have these peaks and valleys, the peaks outweigh the valleys, and they're very short periods of times. So for instance, we have clients that purchased a property in 2017. And if they do a little bit of increase of property improvements of around $50,000, they are going to increase their property value over $400,000. And plus, when they purchased their property for 1.9, by doing absolutely nothing from 2017 to today by doing absolutely nothing, and this is in San Mateo, they're increasing their property value by $200,000. Then if they put $50,000 into it, they're going to increase it another $300,000 to $400,000. That's a $600,000 property increase value from 2017 to July 20th. That's nuts. So that's the peak of value from the Peninsula real estate. And the question is, when is it going to stop? We don't know. This is where I consult for Magic 8 Ball. I don't know. I don't have that answer. But what I can tell you that what I have done is, and I consult with on a weekly basis. I consult with Paris, Naples, Florida, Chicago, New York, the Hamptons, Scottsdale, Beverly Hills, agents from all around the globe, and we consult. We have Zoom calls, and everyone is reporting exactly the same. What's happening is that buyers are creating their own destiny, and just like I was talking about earlier, they are deciding where they want to live, and as they're working from home, and they are having children, they are creating their own home from work, and companies are allowing them to work from home. You're having companies that have these big office structures, and they're converting. You're hearing them that they're going to start converting these big office structures into residential housing. And so what's happening is that they are they're creating their own destiny. And so we don't know when it's going to end. I don't think it is. We will hit a recession. That will happen. And then with every recession, the housing market gets affected. It flatlines. But does it really dip? No, it flatlines. And then as you can see with the peaks and valleys, except for the financial crisis, we really dipped, but then we went right back up. And so, which takes me to the luxury home sales month. July 2020, we hit a huge jump. And this is, 3 million and up. And so, with the luxury sales, we've got Lake Tahoe, Scottsdale, Naples, Martha's Vineyard, Hamptons. And I talk, like I said, I talked to real estate agents in these high end Beverly Hills. Beverly Hills really isn't a second home in the high end. So, even what I did, my husband Mark and I, we bought a second home in Lake Tahoe, and these are destination places: Naples, Florida, the Hamptons, Martha's Vineyard, etc. We bought a second home so that we have a destination place to go to, because what we're able to do is we're able to work from home while assisting our clients, etc., etc. And so you're seeing the 3 million and up take this tremendous jump. And so the question is it going to slow? I don't see it slowing. So waiting from here until next year, it's predicted that 2021 is going to be even a bigger leap than 2020. And so are you going to be a woulda, coulda, or a shoulda, and then look behind you and say, I just missed something? Because the interest rates are so low right now. It is literally free money.
Yeah. And I think that's a perfect segue, Alan, right into for Nikki to talk about some of the rates and talk about like what that market is looking like. And one thing that I saw on that slide that I thought was really interesting outside of the peak and valleys is a lot of how we frame the purchase, right? Let's say you did buy in 2007. Let's say you really did buy right at the peak. Well, the question is, if you looked at that chart for one of the worst financial crises that we've seen, it took about 6 to 7 years to recover from that. But guess what? A lot of that is partly what we discuss, talking to Nikki, talking to you guys, between Nathan and our clients. It's like that time horizon of when you buy the home is also key, right? And when you look at that, you have to have an expectation that there are going to be peaks and valleys, but really hone into why you are buying. And even if we picked the worst point on that chart that you were seeing, it's still something that, as long as it's within that time horizon, that it still could make sense, right? And I think that's really good to see that, right? It's good for people to actually relate to that and see because that's going to be the question. To your point, Alan, we don't know when the drop is going to be, but what if, right? And even in that what if, you have to match it to your time horizon.
Well, and do you always want to be paying somebody else's mortgage? And that's what you're always going to be doing.
Yep, absolutely. And so now what's really interesting that you said there is also what's driving the market in lower interest rates. So Nikki, tell us a little bit about that right now. I mean, everyone's seeing it. Every ad is showing it, right? Like everyone is talking about, right, how low these interest rates are at the moment, right? And so if I think about, you know, the idea of, you know, lower interest rates, like Nate will talk a little bit about how it affects the home prices, but you tell us a little bit about the market itself right now, the mortgage market itself overall.
Oh, absolutely. And yeah, with Alan's chart there, I'm sad to say that his chart went back to the early 90s, and I've been lending since the early 90s. So yes, long time. And I have always said this, and I still maintain it, as long as your time frame is at least 5 years or more, it is always a good time to buy in the Bay Area, period, the end. You just never want to have to sell when it's down. As long as you can hold it, and your time frame is at least 5 years, it's always a good time. Can you flip something and gamble in 2 years? Yeah, maybe not, but that 5 years. So yes, absolutely, time horizon. So rates, it's the very easiest in the X number of years I've been doing this. They're low. They're so low. I can't believe it. I mean, it's like, and there's nothing exciting to talk about in terms of different products, because there's no reason to take anything other than a 30-year fixed, no matter what you're thinking. Because you might think, well, I'm only going to be here 5 years. I promise you, as Alan will probably attest to, most people end up staying longer than they thought in that first house. And there's just no reason not to. It also gives you options, if you do have a 30-year fix, to then keep that house maybe on your balance sheet as an investment property, turn it in, you know, with a 3% interest rate on it, your rate of return's always going to be higher than that. So in most areas anyway. So great, they're great. They're 3% is about across the board what we're seeing. We have, you know, different loan distinctions. So loans under 765 are considered conforming loans. They're probably more like 2.875, 2 3/4 right now. Jumbo is sitting right around 3% for somebody who's well qualified, 20% down, good credit score. So we talked a little bit about buy downs, and I don't know if you want me to show you how a buy down works. I could share my screen if you want me to do that, or do you want me to just talk about it?
I think it's good. Visuals are good, because I think a lot of people don't understand. They talk about wanting a loan that doesn't have any points, right? And I think that's also a misconception sometimes, because some of the buy downs and points can actually be really advantageous. And as you've shared with me, Nikki, it's really attractive right now.
It's really attractive right now. And just as a note, which we're not, none of us are accountants, but on a purchase up to 750,000, which is the maximum, you can deduct the entire points, which is interest you pay up front for a lower rate over the life of the loan. You can deduct that in the first year that you buy. If you pay points on a refi, you have to amortize them over the life of the refi when in a deductibility point. So it's not as beneficial to pay points on a refi. Purchases is the time to do it. If you're going to buy a rate down, do it now. So I have two spreadsheets that I thought I'd just go through. This one on the right here is, I'm not half as fancy as Alan. I don't have my fancy visuals today. I have my boring Nikki stuff. So, but just look at this one right now. For $1.5 million loan, what this is showing you is a rate with 0 points. So 0 points are just percent. Why we call them points, I don't know. But anyway, it's 1% of the loan amount. So 1 point is just interest you're paying up front to get a lower rate. So 3% costs you nothing up front. 2.8, let's just say 2.875. We work in eighths, is a quarter up front. 1/4%, that's $37.50 in dollars. So if you keep going down, you see 2.625, which is 2 5/8, would cost you 1 point, which on a $1.5 million loan is $15,000 up front, which would bring your payment down here. The lifetime savings is $92,000. So it's significant. It's worth doing. This doesn't take into account that tax deductibility that I just talked about, so it's even better. It doesn't really cost you $6,000. It costs you whatever the, so $7,500 is the actual amount that you can deduct, because the IRS limits it to $750. A loan of $750 is the maximum loan amount you can deduct. So in our area, most people have loans bigger than they're allowed to deduct off their taxes. When I'm talking about deducting, what I'm saying is whatever your gross income is, you literally take that off the top of your income and don't pay tax on it. So that's the buy down. It is a great time to buy down. We've been doing a lot of refis buying down where we're adding the actual points to the loan amount. It's just pure math. You guys love math. This is your alley. It's, it's easy. So, and then talking about affordability, is this a great time to buy? Oh my gosh, yes. I would be jumping up and down if I didn't have to stare on the camera because it is such a great time to buy. I've done this. I funded my first loan in 91. It is the most affordable time to buy in my career and in most of our lifetimes. So this one over here, just I've got some numbers in here. This is what I use to kind of run numbers with somebody when we're doing high level qualifying. And I just picked, if you have a 2 million loan amount, 20% down at 3%, that gives you a $1.6 million loan amount, 2 million purchase price. That would be the mortgage payment, $6,700, taxes and insurance. This is what we call PITI, principal, interest, taxes and insurance. From a qualifying perspective, we divide that plus your other debt, credit cards, car loans, students, by the monthly income. The reason that I'm bringing this up is we need to be somewhere under 43. And in this case, you can see here, we're at 49. 49% of your gross income is going towards your total debt. That's the lending world. That's not what you guys will talk about, which is what makes sense in like the real life with all the other cash flow things you have to take into account. But in the lending world, we're looking at 43. So if I just take that rate up to 4% here, if rates were 1% higher, you see how this number popped up to 45. So I would have to drop this to about $1.8 million to get back to the same price range, back to the same DTI. So you guys had mentioned this, I think, in another webinar, that a 1% drop in interest rate gets you about 10% more in price, which this one just showed you there. So you guys were right. Good job with the math. So yes, it's an amazing time to buy. Couple other things just to note. If you have bonus income, so bonus income goes into qualifying. I've been hearing stories now that the bonuses are getting maybe not going to happen this year, so not as many bonuses. When we're qualifying on somebody who's salaried, we will look at the last 2 years of bonus. So we'll look at 18 and 19 currently, and we will average that. And that goes into this number here. So let's say you get, I don't know, 10,000 a year. So I can put 833 in here on a monthly basis for average bonus. So this gets me more house. It means that this debt to income ratio went down, which means I can lend you more. If you don't get a bonus in 2020, come the spring of 2021, I can no longer use anything. Even though it was only 1 year that you didn't get a bonus, we now have to wait 2 more years for you to actually use that bonus income. And for most people, this is more significant. This is more like $3,000 a month. We see most bonuses, I don't know, the big tech companies in the sort of 20 to 30,000 range. So this could be significant. In January, your qualifying could be harder than today. Not to mention stocks. Stocks, that's a whole long conversation I won't go into, but stocks is somewhat similar in that we're going to use a history of what you received and what the stock price was for qualifying. Let's see, a couple other things that we talked about were there's you might have read in the papers a rate increase. The Federal Housing Finance Administration came out and slapped a 0.5 point fee onto conforming loans. So these are loans under 765, which isn't so relevant for us. But just don't be misled by that. That's only for refinances. So it does not affect your purchases. So rates have not gone up for purchases, all the smaller ones. It's just for those people who are refining the small loans. It was intended to penalize the banks. Of course, what did they do?
Pass it on. Yeah.
So that. One other note just on the topical things right now, because of the fires, if you're looking in an area in the hills, insurance is tough. We've had a moratorium right now on Los Altos Hills and Portola Valley, just came out today with some insurance agencies. If you're in La Honda, Santa Cruz Mountains, you're probably not going to get insurance right now, or it's going to be really hard to get it. It's going to be expensive. So just watch that.
Yeah. And Nikki, that's a really good
just
point.
to state it out loud, Nikki, when you say 2-year average for bonus, is also the same for RSUs?
Well, so that's it's a 2-year,
okay.
2-year average of the amount that you've had awarded times by the lower of the 2-year average of the stock price or the current stock price. As long as what you have going forward for 3 years vested matches what you had for the last 2 years.
Okay.
So
I think the most important takeaway is if you haven't been at the company vesting for 2 years, you're not going to qualify that, right?
Yep. Yep. It's normally you have to get 3 years.
Helpful.
Some companies who, if you vest after the first quarter, then it's 2 years and a quarter. But many companies, you don't start vesting until the first year. So it's actually 3 years that you have to be there before we can actually use that as income.
Good point.
Yeah, and then the point you made about the bonus, like if you're not receiving it, it resets the timing, again, affecting qualifications. That's something to consider as well, right? And so, you know, and tying back into, I mean, again, the webinars to talk about like, is now a good time to buy? And you know, it really, you know, I can't stress enough, like there's always going to be nerves around doing this. It's one of the biggest purchases that you're going to make. And we get that, right? And we host these webinars to give you as much of the information as possible that we have on hand to help you make the decision. Doesn't mean you're not going to be nervous, because you still will be, right? But the idea is having the right mindset and framing as you go into this, right? And so seeing what the interest decrease, Nate, right? Talk a little bit about that. Seeing what that decrease in rates actually does to your purchasing power, I think is really, really interesting.
The other thing,
I think Nikki, sorry, go ahead, Nikki.
Well, I was just going to talk about affordability versus qualification, because you guys are so good at that, as do we as a lender. We do more work with just the qualifying, because that funny feeling that you have in your tummy when you're like, oh my God, I'm going to buy it. Should I buy it? It's if you are grounded financially, it takes that away, because then you know, okay, I can handle this. I can still save for college, or put my kids in daycare, or actually go on a vacation and not eat top ramen. And, you know, so it's having the grounding in the finances that enables you the power to make a much better offer. And Alan and I recently had a client who came to us and they were looking, you know, $1.1 million, $1.2 million, maybe, because that was their ungrounded assessment of what they thought they could afford. Once we did the planning work with them, they just are in contract for $1.65 million, because they now are so comfortable that they can afford it, that they can cash flow it, they can still put the kids in college. So it's very important to be grounded on the affordability, the numbers. It's all about the numbers.
And that goes back to the time frame that we were talking about, right? What's the chances of someone buying a $1.2 million house actually feeling comfortable in that house for the next 7 to 10 years, or even 5 years? They're probably going to be feeling very cramped. But now, guess what? They're in a $1.6 million house, probably can raise their kids in that house, be comfortable in that house, and not feel like they have to move anytime soon. So that's huge.
Got them out of a condo, it got them out of townhouseville, it got them in a better neighborhood, better schools.
Amazing.
And it's going to increase their
Hey, Alan, move forward, because we can't hear you. There you go. There you go.
Okay. It actually got them into, got them out of a condo and a townhouse. It got them in a better location. It's going to increase in appreciation and value much quicker. And so all around, they're much happier with this. So.
Yeah. And maybe from an affordability perspective, it might feel a little bit uncomfortable for the first year or two, but most of their housing cost is going to stay relatively fixed. But generally, at least in the Bay Area, your income's going to keep rising and rising. So 2 years from now, 3 years from now, that payment's not going to feel as painful as when you first bought it. But now, guess what? You have the space to stay in that home, to grow into that home. And as much as Alan wants to help you with all the different transactions, you're probably going to feel comfortable staying in that home for 7 or 10 years instead of reaching back to Alan in 2 or 3. So I think that's super helpful of you guys that you're able to do that for that client.
Yeah.
I have one more thing to just add, that on loan programs, a creative program that we have that I think is relevant very relevant for our area, and it's relevant because we created it for the area. So it's an expensive area, and it is hard to save the down payment. So what people keep finding is that they keep trying to save the down payment, the house prices keep going up. So we have a program that allows us to put just 10%, so 10% of the purchase price. If it's $1 million price, that's 100,000. If it's $1.5 million, that's 150, down as the down payment. Now, a lot of loans in the past have had what we call mortgage insurance. So if you have a less down payment, you have to have a high insurance premium to cover the risk for the lender. This program does not have that. It also doesn't require a lot of reserves. So it's a great stepping stone. It's a great way to get into the market today while we still got the bonuses, while we still qualify. And then what we do is we tend to refinance people out of it in a year or so's time once they've got more stock that's come in, or the IPO has happened, or whatever that thing is that's coming. But it's a great program. So you can allow 10% down to a purchase price of about $1.65 million. Certain cities, but it's all about cities. It's just it's for the expensive cities. So San Francisco, through the peninsula all qualify. So Note
That makes sense. I think something that so many of my clients are talking about and wondering about is they hear on the news all these rent moratoriums are going on, all these loan forbearances are going on. So when those come due, we're probably going to see a huge wave in inventory, right? I don't think that applies to the Bay Area, right? A lot of the loan forbearances apply to government-backed mortgages, which are conforming 765 or less. How many people actually have a government-backed mortgage in the Bay Area that's not, more importantly, not making their payment on that as well? I think that's very few and far between. So this huge wave of more inventory coming onto the Bay Area that people are hoping for, I don't know that that's going to happen. Now, that could happen to a lot of other cities across the US, but I think the Bay Area is just so strong financially. I personally would not be waiting for that fallout to happen before I buy. So as much as you may see that on the news, I just don't think it's applicable to the Bay Area, unfortunately. Well, unfortunately is the wrong word. I don't want to root for anyone to be displaced, but I don't see that helping prices.
It's all based on employment, and employment around here is high tech, and high tech's doing great because guess what?
Right.
We're all sitting at home using high tech to try and get our jobs done.
Well, and I receive on average at least one phone call a week on regarding that question exactly. And the other is that over the last 7 years, 8 years, buyers were putting 30, 40, 50% down. And so the housing has appreciated so much. And we've heard, we were just talking about clients that bought in 2017, how much is appreciated. So if somebody's missing a mortgage payment, their mortgage payment that they're missing on, they're able to turn around and sell the house and get out from underneath it. So it's just not here, unfortunately, or I shouldn't say unfortunately, it's just not happening.
Yeah.
Right.
Nate's rubbing off on you on that one, right? But and look, you know, like we are running up on time here, and I wanted to do a little bit of summarizing to get the point across about where we are today. I think, as I mentioned in the middle of the webinar, it's reasonable if you're looking for a house right now to feel nervous. We're all feeling very nervous about multiple things right now as we look at our day-to-day lives, and so what you're feeling today isn't something to say, oh, after watching this webinar, to say, no, I shouldn't be feeling nervous. It's more just to say, let's feel grounded about what we're nervous about. Like, why are we nervous? Figuring out the reasons behind that so that we can say, let's drown out some of the white noise. Let's think about why are we actually buying still, and focus that back in on that. If we can focus back in on that, you'll realize that, hey, you know what? All the rates are still looking really good. The purchasing power is great. As Alan mentioned, you know, it's still going to be some high demand right now. Things are getting snatched up really quickly, right? Not sure that's going to change anytime soon. And how long are you going to wait? To Alan's point, are you going to be like, oh, I should have bought, right? And so if you can ground that question back to the reason that you are buying, I think it's going to be really helpful for you to say, this is still the right decision. And so that's the whole point about this, is to review all of these points and for us to say, you know what, it's not going to be a bad financial decision. I think that's a lot of what people are looking out of, is like, oh my God, I'm going to make the worst financial decision of my life right here. And we don't think it's the case, right? We don't think that is the case of what you would be doing at the moment. Let's take a look here. Let's see if there's any questions. There was a question that came in, and Nikki, I think this refers for you. It says, for the program that you're mentioning, does the East Bay count? Like, right? Is that part of the program?
Yeah, there's certain cities. So just contact me. I don't know, you guys will put my email in there or something. But yes, it's not for, I don't know, Haywood, so to speak, but it definitely is in Berkeley, Danville, San Ramon. Oakland just got removed from the list, and we're fighting that right now because we don't know why. So, but it's yeah. So
there's plenty of expensive homes in Oakland. I'm surprised.
I know. There's a formula. It's a fair housing formula. It goes by an average of incomes to, you know, price ranges, and it's a convoluted formula. And for whatever reason, it got bumped out. But we're working on bumping it back in.
Sounds good.
Nice.
Awesome. Well, again, I wanted to close out the webinar here, thanking Alan and Nikki for joining us. Such a fantastic time always to get the input from both of you. And again, for us, you're going to see this posted on our Facebooks. And I know our marketing teams will share it across our platform so that all of you will still have access to it. As we do that, there will be emails and links to our team as well. If you guys want to talk more with us individually, you'll be able to access that, whether it's through the Diversified team, Alan's team, or Nikki's team. So we'll provide that as well. But please feel free to reach out to us at any time. If you want to learn more specific about your individual situation, that's where the conversations one-on-one is really going to help more about. Okay. Any closing?
I'm happy to run those numbers with anybody. Just call me. We'll do a quick run through, high level.
Yeah. Any other closing remarks here before I end the webinar for us?
Just one. Nikki, could you please explain the pre-approval that you can't have the credit rating drop?
Yes. It is, you cannot buy a house in the Bay Area without a pre-approval. And pre-approval doesn't mean you and I have just done that little spreadsheet and we said, oh, things look lovely. It means you've given me your tax returns, you've given me your W-2s, you've given me your pay stubs, we've run credit and everything looks good. And then Alan can go and you can put in a non-contingent offer. In order to compete, you have to be non-contingent in this market. So what we're used to doing that, we know how to get you in a contract without any contingencies, which means you have no outs. So it's up to me to make sure that we get you pre-approved and what we're doing. So part of that is pulling a credit. Pulling a credit for a mortgage, it'll maybe take 2 points off your score. It does not matter. If your precious score of 810 goes to 808, it really doesn't matter. It might matter if your score of 650 goes to 648, so that we have other problems. And by the way, I have a client right now who has a 640 credit score. We just did a simulation where we can see if we remove this, what would the score be? She had a stupid collection that was just recent. It's an error. We get this collection removed. We can rescore. So she's already in contract within 48 hours. We have a score back to 720. So she can now qualify. So that's a side. But yes,
Great.
Running credit is super important. It doesn't affect your score. Do not say, I'm not going to run my score credit because I don't want, that many credit checks. We have to know what's in there. Those silly little credit dings that you didn't know about happen. This lady was a doctor and it was a medical thing. She had no idea it was there. So depth matters. We're not just looking at score. We're looking at the amount of credit you've used. So if you have an old credit card, we might have you go put a tank of gas on an old credit card because we might actually need that. So it's very important for us to know that with enough time, rather than when you're telling Alan, oh, I like that house and I'd like to buy it. Too late then. That's not quite too late.
Awesome.
Thanks for asking that, Alan.
Thank you.
All right. Well, thank you everyone for joining us today. It's always a pleasure to have these chats, and wanted to make sure that if there are again questions, reach out to us. But in the meantime, I'm going to say happy Friday, and I'm going to close out the webinar here.
Bye, everyone.
Happy Friday.
Bye,
Thank you so much, guys.